how much new money can be created within the banking system from one new deposit, we take a look at the fractional reserve banking system to see this. And the fractional reserve banking system is what the United States currently uses within all of its banking. So here, when a bank receives a deposit, a portion of it is held in reserves, and the other portion of it is going to be lent out. So just the entire process that we've been talking about through this entire chapter. When a $1,000 deposit comes into the bank, a portion of it is going to go to reserves, so required reserves, and the other portion of it is going to go to loans to customers and other businesses. But here, in order to see the maximum amount of money that is going to be created, we need to work with one further assumption, and that the bank is going to be fully loaned up. So here, with this entire transition that we're going to be talking about, we assume that the banks are fully loaned up. And fully loaned up tells us that the bank is going to hold only the minimum required reserves. They're not going to hold any excess reserves at all. So banks loan out all they can, and keep in reserves, only the amount required by law. Only the amount required by law. So essentially, the excess reserves are equal to 0. Excess reserves equal to 0. So with all of this, they are lending out as much as they can, and when banks lend out as much as they can, that means they are generating the most amount of profit they can get. There are a lot of good reasons why banks would want to be fully loaned up, but there are also reasons why banks shouldn't be fully loaned up. Basically, they just want to have some type of buffer against bank runs or some type of economic crises. When banks are fully loaned up, however, we get the special situation where the reserve requirement is actually equal to the reserve ratio. So reserve requirement is equal to the reserve ratio. So in this instance, when banks are fully loaned up, the minimum reserve requirement set by the Federal Reserve is exactly equal to the bank's reserve ratio. So basically, the reserves are equal to the required reserve. So it's a very special and unique situation that banks usually shouldn't be in. But in this example, we are going to work with this idea in order to see the maximum amount of money that is going to be created within the banking system. So let's go ahead and work with this transition. It's kind of a clunky example, but it proves its point fairly well. Suppose that we have Bank A right here. So here, suppose $1,000 is deposited into Bank A, let's call it Wells Fargo, and the reserve requirement is 20% for all banks. The balance sheet is going to look something like this. So you deposit $1,000 into Wells Fargo. The Wells Fargo is going to be fully loaned up, so it's only going to hold a minimum, the legally required minimum amount as required reserves. So that's going to be 20% of this $1,000. So we get $200 in reserves. And what are they going to do with the other portion? They're going to lend it out. So $800 in loans made out to a person. And suppose that this person actually does banking, say at, let's go ahead and say Chase Bank, for some strange reason. So here, let's go ahead and this $800 loan goes to person B who banks at Chase Bank. And suppose that this person is going to deposit his $800 loan into Chase Bank. And Chase Bank, remember, is still required by law to hold 20% of all new deposits as required reserves. So it shows up as $800 into Chase Bank's liabilities. 20% of this $800 is $160. So Chase Bank has to hold this by law, $160. But because they are fully loaned up once again, they are going to loan out the other portion, so $640, which goes to person C. And suppose that we repeat the same process, and person C is going to go ahead and do their banking, say at maybe let's say, what's another bank? Let's go ahead and say SunTrust Bank. So here, they take the $640, deposit at their account at SunTrust Bank, and we have Bank C right here, SunTrust, $640. Remember, they are still legally required to hold 20% of all new deposits as reserves, as required reserves, $128 right here. They are fully loaned up, lend out the rest amount, and then so on. And we've only gone through 3 banks right here. We've gone through Wells Fargo, we've gone through Chase Bank, and SunTrust Bank. And we already see that this initial $1,000 deposit that went into Wells Fargo, it's actually created a lot of more money in terms of loans. So here with Bank A, B, and C, Wells Fargo, Chase, and SunTrust, we notice that we don't necessarily just have $1,000 in deposits. We now have $2,440 worth of deposits so far right here. So we've actually created new money in this type of sense. We notice that, hey, this $1,000 deposit has actually begun to create new money because loans are being made, and that's actually created some type of value for person B, person C, and so on down the line. So with just 3 banks that we see right here, new money has been created. And if we actually continue on this entire process through bank D, E, F, all the way to Z until we loan out the entire amount, until we get all the reserves back of our initial deposit, how much new money is actually going to be created, we come to this final balance sheet right here for all the banks. And we notice that the $1,000 original deposit turns into $5,000 into deposits now. So here we're able to successfully say that, hey, your $1,000 original deposit has created 5 times as much money as before. So here we notice that, hey, $1,000 of money of initial deposit has created 5 times as much money. And this is an entire transition that we went through with the fractional reserve banking system where banks are going to be fully loaded up. And if we just wanted to get to this final sort of impact that we have right here, we don't necessarily have to go from bank A to B to C. We can entirely skip all of those steps and come to something known as the potential money multiplier. And the potential money multiplier just tells us that when we see an initial deposit coming to the bank, we know exactly how much new money can be potentially created within the banking system. So let's go ahead and take a look at the formula and skip this entire transition because it is a rather clunky example. So with the potential money multiplier, it measures the maximum amount of money, the maximum amount the money supply can increase when new deposits enter the system. It's defined by 1 divided by the reserve requirement. So here we want to go ahead and detail this just a little bit more, because there are different types of money multipliers that we take a look at. This one is going to be called the potential money multiplier. Money multiplier. And it's called the potential money multiplier essentially because it is telling us the potential amount of new money that can be created. So theoretically, what is the most that can be created within the banking system? So with the potential money multiplier, as we saw, it's going to be calculated as 1 divided by the reserve requirement. And 1 divided by the reserve requirement, we need to put the reserve requirement into decimal form. The reserve requirement we had with this example was 20%, so 1 divided by 0.20. And this potential money multiplier, 1 divided by the reserve requirement, will give us a money multiplier, a potential money multiplier equal to 5. So that tells us that any new deposit that comes into the banking system, it's going to create 5 times as much new money theoretically. So we had a $1,000 new deposit, $1,000, which was our initial deposit. We need to go ahead and multiply this by our potential money multiplier. So put this down here, our potential money multiplier. And then when we take the product of these two numbers, we will see exactly how much new money is created within the banking system. So 1,000 times 5 will give us $5,000 of new money. So how much new money is created in the banking system? So essentially, our money supply can increase by a potential amount of $5,000. So here, $5,000 of new money can be created, and we don't have to work with this entire clunky transition that we have going from bank A to bank B to bank C. All we need to do is to go ahead and use our potential money multiplier that we see right here. So with all of this in mind, the potential money multiplier is going to be higher the lower the reserve requirement. So the lower the reserve requirement, it just tells us that the bank can lend out more and more money. And if the bank can lend out more and more money, the higher the potential money multiplier is going to be. But how often do you think the bank is going to reach the full potential or the fullest extent of this potential money multiplier? And in actuality, in application, it rarely hits the potential money multiplier, essentially because there are things that are going to sort of dampen the impact of this money multiplier. So in our next section, we're going to go ahead and take a look at the sort of leakages or things that are going to dampen the impact of the potential money multiplier and see what new multiplier, the actual money multiplier, is going to lead us. So there are going to be big differences between what we see theoretically and what we see in reality, just like we do with our economic models. So here, potential money multiplier, very easy to calculate, 1 divided by the reserve requirement, and it tells us exactly that how much new money can potentially or theoretically be created within our banking system when one new deposit comes in. We'll go ahead and just change this up a little bit when we introduce leakages and the actual money multiplier in our next lectures. I'll see you guys there.